Okay, hi everybody. Tonight's presentation is very interesting. I've got three clips to show you. So this is how our experts, in this case Reserve Bank Governor Philip Lowe, can change their mind in a very short period of time, although no condition has been met in which they said they would change their mind. Okay, what am I talking about? This is the double or triple whammy for Australian property because it's highly leveraged. Okay, so this is the video of Philip Lowe speaking in Sydney on the 8th of February 2018. Today's 14th of April 2018. So a little bit over 2 months ago, this is what Philip Lowe had to say.
And despite central banks like the US Fed raising rates, the governor says the RBA won't be hiking rates anytime soon. Carrington Clark was there.
Reserve Bank Governor Philip Lowe has effectively ruled out any possibility of an interest rate hike here in Australia anytime soon.
Okay, so ruled out absolutely any rate hike anytime soon in Australia, right? Get that. I mean, that couldn't have been any clearer than that. Get that?
Following a week of market volatility stemming from the US, where a hint of inflation set new expectations that interest rates there would be rising sooner and faster than previously expected, Philip Lowe says there is no reason Australian interest rates need to move up lockstep with their overseas counterparts. Instead, Philip Lowe says conditions here in Australia are very different to what they're seeing in the US, and until we see strong evidence that wages are growing higher than the currently record low levels we're seeing, there'll be no reason to rate hike soon.
Just as we did not move in lockstep on the way down, we don't need to do that in the other direction. It's clearly understandable why some other central banks are starting to raise interest rates. They lowered their rates by more than us, and the unemployment in a number of countries is now below conventional estimates of full employment, and this is at a time when further above trend growth is expected. Again, our circumstances are a little different.
Our circumstances are a little different. Some of the most, four most expensive words in the English language are, at this time it's different, or we are somehow different in this global economy, globalized world, whether you think it's round or flat. Now, this is what Philip Lowe is saying right now.
It's not coming anytime soon, but the head of the Reserve Bank has warned an inevitable increase in interest rates will shock some people. Speaking in Perth, RBA Governor Philip Lowe reiterated a move is not expected soon, but said the move is, you guessed it, up.
The last increase in the cash rate was more than 7 years ago. So when an increase takes place, it will come as a shock to some people.
So to be fair to Philip Lowe, he did again say it's not going to happen anytime soon, but they are telling us about it. So they're obviously preparing us for something that is going to happen, and he's just said it. It's going to shock some people. This is what he said.
Future. Shareholders have it.
Okay, a slight correction there. The first video was from the 8th of February, and this video is actually from the 11th of April. So that's just a little bit over 2 months. Today is the 14th of April, so I'm recording this 3 days after Philip Lowe gave this speech. So this is what he's saying now. This is what they're preparing us for.
The last increase in the cash rate was more than 7 years ago. So when an increase takes place, it will come as a shock to some people. But it's worth remembering that the most likely scenario in which interest rates are increasing is one in which the economy is strengthening and income growth is also picking up.
Dr. Lowe also noted the high level of household debt remains a source of vulnerability, but lending standards have been strengthened.
Okay, so lending standards have also been strengthened. So we got the from increase or the interest rates are not going to go up anytime soon to they're not going to go up anytime soon, but they're definitely going up, and it's going to be a shock to many people. And by the way, the banks are strengthening their lending standards. That's going to dry up the liquidity. And then we got this bombshell. You remember those liar loans where people overestimated, and their brokers, and nobody really cared how much people actually earned, what the income was. They overinflated the income figures so they can borrow as much money as possible using these inflated figures. In America, these are called ninja loans, no income, no job loans, but these are no money down, and also, I'm not sure about no money down, but interest only loans. So you don't have to pay off the principal of the loan, you're just paying the interest for a few years. Now, after those few years are up, meaning that your honeymoon with your bank is over, you're going to have to start paying the principal. And so this is another thing apparently that's coming up, that a lot of these loans will end up costing people 30 to 40% because they're going to have to start actually eating up and trying to pay back some of the actual principal, which is the whole idea of paying the mortgage so one day you don't have a mortgage. But listen to this. This is a bit scary, actually.
The Reserve Bank has put borrowers on notice, sounding the alarm on the looming deadline for $500 billion worth of interest-only loans. In its Financial Stability Review, the RBA says $120 billion of interest-only loans will expire each year until 2021. And that means borrowers will be facing a 30 to 40% jump when they are forced to move to paying down the principal. Although the RBA maintains most borrowers can handle the hike, it expects a minority will struggle and could be forced into fire sales. UBS Chief Economist George Saranu was predicting problems in the housing market before the release of that Financial Stability Review. He thinks after the Royal Commission, the banks are going to have to lift their lending standards, making it much harder for people to get credit. And with less credit, house prices are going to fall. I spoke to George Saranu earlier today. George Saranu, thank you for joining the business.
Thank you.
Now, you've been sounding the alarm on house prices and the possibility of a large correction in house prices for a while.
Yeah.
What is actually going to be the catalyst this time? What's different?
The key issue facing the Australian housing market is that with the pressure of a Royal Commission and banks facing greater regulatory scrutiny, we think they will tighten their lending standards, and you're likely to see a persistent fall in home lending and credit availability over the next few years.
But why does that hurt house prices? Surely it shouldn't just be determined by how much money somebody can borrow.
Well, historically, the supply of credit, rather than the supply and demand of people and home building, has been the key determinant of house prices.
Okay, so get that. This is a very good point. So it's not how many people are coming into the country, which is the lie that they've sold us time and time again, meaning that immigration, there's enough demand, there's not enough supply. That is not what determines the housing prices. It is the availability of credit, because all of those people that are coming in, or at least 95% of them, need credit to buy. They don't have cash. Very few are rich. And those rich ones are buying properties that are $5 million and up. They're buying mansions, they're parking money. You and me, my friends, we are paupers for most part compared to those people. We need credit, and when the credit dries, so do the property prices drop.
It's really about the marginal flow of credit availability that determines house prices for everybody. You can think about the simple example in Western Sydney where people are saving to buy a home and they can put together a deposit of around, say, $100,000. And a typical home in Western Sydney currently is around $750,000. So they're needing to borrow to fund that purchase a significant amount, around $650,000. And for a lot of people on a family income of around $100,000 to $125,000, they're having to borrow a significant amount of money, around 5 times their income. Now that's been pretty normal in this cycle, but historically it's not. Traditionally, banks would lend something like 3 to 4 times as a ratio of income. Now we think what's going to happen under this credit tightening scenario is that the availability of credit will probably fall something like 20 to 30%.
So if we're seeing credit crunched in the effect that the banks are going to be lending to those same people 20 to 30% less money. Does that mean do you think they'll be bidding 20 to 30% less for those same houses?
There would be a significant step down in prices, but not every single person's borrowing the absolute maximum. What it really does is reduce the volume of activity, and also with a lag, people who are under stress looking to sell will have to just meet the market. And so I think you'll see this persistent grind lower in house prices over the next couple of years.
How quickly do you think we'll see a real impact on house prices?
I think it is going to take some time. If you think about that, the change in lending standards is really only happening right now. It will take a number of months before people realise that their maximum borrowing capacity has reduced. When they go to the bank to make an assessment, they're going to get a lot less than they thought previously. Then they will change their decisions around, well, how much can I actually afford to borrow? What type of home will I want to actually be able to get? And then over time, you see a reduction in activity and prices in the housing market. I would think this process is going to play out over the next 12 months or even perhaps 2 years. And it wouldn't be surprising to me to see a credit tightening scenario drag down house prices persistently. Because what normally happens is the RBA, if there's an environment of weak house prices and a softer economy in the back of that, would just cut the cash rate. They did that in 2016, and they re-accelerated housing quite strongly. We saw a return to double-digit house prices. They're not really pushing that angle right now. The RBA seems quite comfortable with interest rates where they are, and they want to reduce risk in the housing market. So my view is things probably have to get worse before they get better.
The Reserve Bank, out with its financial stability review today, they've pointed to interest-only loans and the deadline or expiration dates on these loans over the next 4 years as putting about $500 billion worth of interest-only loans up for renegotiation, if you will. And they've said they are concerned about people not being able to afford that rollover to principal and interest. How big a problem is that for Australia?
I think the issue for the interest-only expiry is that the flow of new lending that led to the boom in house prices was very easy. There was around 40% of loans that were written on interest-only terms, and also the income assessments and the living expenses assessments were quite lax. Going forward, I don't think that policy tightening will reverse. And so the issue really is not about the ability of the expiring stock of interest-only loans, whether they can repay them, whether they will default. I think it's more about the availability of credit for the new marginal borrower.
So the boom is over.
That's right. I called the top in housing a year ago because of the macroprudential tightening, and it's playing out. I think we're just at the starting point of what I've called the third phase of macroprudential tightening around regulation and lending standards, and that's the direction policymakers want to take. Longer term, it actually is positive. It is clearly reducing risk in the housing market, but the problem we face is the adjustment to go from A to B. To go from a period of easy lending standards to tight lending standards runs the risk of unintended consequences, and that could be the so-called wealth effect, where the drop-off in house prices causes consumers to drop their consumption, and that feeds back to the labour market. This is not really around banks and a blowout in bad debts. That's a really Armageddon scenario which seems unlikely, but it is likely to have a broad macro impact that's quite weak for the next 12 months or so.
George Saranui, thank you for joining the business.
I think this man is going to make a name for himself. I mean, at least people will listen to him. They're not going to listen to me, and I only report what other people and other people's research and what other people report, or at least put out there, like this man from UBS. UBS, I believe, is a Swiss bank slash financial institution. And they pretty much do everything, I suppose. And he wasn't mincing his word. I don't mean this in a patronizing way, but if that hasn't sunk in, just once again.
So the boom is over.
That's right. I called the top in housing a year ago because of the macroprudential tightening, and it's playing out. I think we're just at the starting point of what I've called the third phase of macroprudential tightening.
So the boom is over.
That's right.
Here it is, ladies and gentlemen, one more time.
So the boom is over.
That's right. I called the top in housing a year ago because of the macroprudential tightening, and it's playing out. I think we're just at the starting point of what I've called the third phase of macroprudential tightening around
Take care, everybody.